Lopez for NYSC TV, and joining me today is James Stone. He is a partner at PennantPark. We continue our private credit investing video series with episode 5, where we will cover all the buyout process. Thank you for joining me today, James.
Thanks, Trinity.
So I want to talk more about the buyout process, but first, can you walk us through a typical middle market buyout transaction?
We work alongside private equity firms, or deal sponsors as we also refer to them. Sponsors acquire companies, improve and grow their operations to create value, and then look to exit these investments at a later date and a higher price. That's how they generate profits for their investors. Sponsors purchase these companies using a combination of cash from their investment funds and debt financing. That's where we come in. When a sponsor identifies an attractive acquisition candidate, they'll reach out to lenders like PennantPark to provide the debt. These are invitation-only opportunities, which is why it's so essential to our business to have direct relationships with the sponsors.
And speaking of those relationships, can you elaborate on those relationships that PennantPark has, and how did you find them in the first place?
Our investment team maintains an active dialogue with more than 700 middle market private equity sponsors. We've built these relationships over many, many years at PennantPark, and we have senior members of our investment team located throughout the country close to where the sponsors are. I'm based in Los Angeles and spend time in the Western US. We've made investments with more than 200 private equity firms and executed multiple transactions with most of them. The sponsors have come to know us as a reliable and value-added lender to their portfolio companies, which enables us to get the first call and the last look. The relationships have to work both ways. We seek to work with private equity sponsors who have a proven track record of supporting their portfolio companies. If one of our borrowers experiences difficulties, we want to know that a sponsor is prepared to inject additional equity capital into the company. There has to be an alignment of interests.
Now, moving back to the process, let's talk about what happens after a sponsor brings a deal to PennantPark.
Once we get through the screening phase, we commence our in-depth due diligence process. Now, it's important to note that most opportunities never even make it that far. We ultimately pass on about 95% of the deals that we see, so it's a pretty high bar even to make it into the diligence phase. During diligence, our investment team analyzes all of the available information. This includes a company's business plan, conversations with the management team, evaluating industry trends and the company's customer and supplier relationships, and of course, a thorough analysis of their financial reporting. We also benefit from independent research that the sponsor commissions, such as industry studies, and we always do our own independent channel checks and expert calls. Finally, we negotiate pricing and terms with the sponsor, and will often seek to make a modest equity co-investment alongside the sponsor.
James, can you tell me about when PennantPark's investment committee actually gets involved?
We start the dialogue with our investment committee early in the process and provide multiple updates as negotiations progress. What's unique about PennantPark is that all of our investment professionals participate in the investment committee process. We seek perspectives from the junior-most associate to our senior partners. We really value this comprehensive range of views, and ultimately the investment approval process is consensus-driven.
Now, James, tell me exactly what happens when the investment committee votes yes on a deal.
That's when the fun begins. Once we complete an investment, we start earning interest on our loan for as long as it's outstanding. We monitor the borrower through monthly financial reporting and regular check-ins with the sponsor and management team. We're prepared to hold our loan until its maturity, but we're often repaid early due to a refinancing or sale of the company.
A lot of great information, James. Thank you so much for joining me today.
My pleasure. Thanks, Trinity.